Well, good morning, everyone. Today is October 2nd, and the market was down about 300 points yesterday, a little over 300 points actually. And now you're looking at the S&P, and this little bar here that you see, this little, I call this Gilligan's Island because it's kind of like away from the mainland. Funny, right? Gilligan's Island. This looks to be where the S&P is going to open, which is clearly below the 50-day moving average. Why did the market dump yesterday? Weaker than expected manufacturing numbers. China US trade war is taking a toll on the economy. Moreover, in the news today, here's the headline. Europe makes appeal to US, let's avoid another tariff war. The European Union is appealing to US President Trump to avoid any tit-for-tat tariff war, issuing a ruling, impose billions in duties in European produce. Nobody wants that right now. That's going to break the market lower. So we're trying to avoid that. Not sure how that's going to resolve, but if we have part two of China and US with Europe right now, that's going to put real weight on the market. I mean real weight. Because keep in mind, the market is not absorbing any of this news yet. It's already been absorbing China for what, close to a year now? So that's not positive. Let's look at a few indicators. So again, S&P 500, it looks to me like we're going to trade between the 50-day line and the 200-day line, and utilities and consumer staples are leading again. So we're not seeing offensive or tech stocks lead. As a matter of fact, technology, as you could see here, is already deeper inside the 50-day moving average. Let me show you this. Hard to read these charts. Let me make it a little prettier for you. All right, notice we're already deep. We've already been trading inside the 50-day moving average for about a week, whereas the S&P is just getting started. So it's an issue. Tech is definitely, via China, because of China, taking a big toll on the technology and speculative stock like consumer discretionary stocks and technology stocks. Don't go long those sectors now. The question becomes now is, what do we have in store for the second part of the week? Well, we have jobless claims. Today's not a big day. We have petroleum status reports. Not expecting too much there, especially after what we saw last week and the week before with crude oil. Expecting that to just kind of soften up more. Tomorrow's a big day because we have jobless claims. We have another manufacturing index. This is non-manufacturing. This is the ISM non-manufacturing index. But another another ISM report coming out. And we also have factory orders. But the big report is going to be jobless claims. Jobless claims is going to set the tone tomorrow. Let me give you the numbers here. 216,000 is the consensus. If the number is below 210, that's going to be positive. That means we have lower claims than expected. If the number is going to be above 219,000, that's going to be a bearish signal for the market. Now, let me show you something positive. This is the put to call ratio. It's been actually kind of bearish, and the market's been kind of nervous the last few days. So it doesn't look like we're going to go down really hard. It looks like we may just kind of softly move between the 200-day and the 50-day moving average. So that's positive. That's telling me that the market is kind of stretched out already. It's not just getting into a stretched out mode, which usually happens when we begin a little bearish cycle. It's already there. So the market's not expecting anything new. In light of that, the VIX, this is the short-term volatility index, it's already near 20. So unless we're going to see something really bad over the next few days, like really low or really high jobless claims or really bad employment data that's coming out on Friday, let me show you that. Employment situation and Jerome Powell speaking. Unless something really bad happens here, right here tomorrow, or here, or here. In other words, worse employment situation, higher jobless claims, Jerome Powell talking about Europe and China again. That's going to impact the stock market, cause us to go a little bit lower, and bonds to rise again. Keep your eye on the bond market, because the bond market rallies when stocks go down. We're already expecting to go open a little higher, and I'm expecting bonds to begin trading above the 50-day moving average, especially if stocks start trading between the 50-day and the 200-day. Let me show you that again. Sorry I'm going back and forth so much, but I want you guys to get a really good idea of what I'm looking at and the dynamics. I don't want to just give you a conclusion. I want you to understand where I'm coming from and why this matters. So again, if we start trading between the 200-day and the 50-day, you can expect the bond market, TLT, to start really trading higher and start hitting highs. If you see really negative employment data tomorrow and Friday, if you see Jerome Powell talking about how bad things are getting, expect bond to rally and expect the S&P to continue trending slightly lower, but don't expect major selling pressure. We're not there right now. There's really nothing on the table that's unforeseeable right now. Everything on the table is expected unless this European tariff situation starts playing out. That's totally unforeseeable. So let's start paying attention to that. Earnings officially don't start for another week and a half with bank stocks. So far, we've had a couple of stocks come out or coming out, and the earnings have been mixed. All right, I'll give you a full update tomorrow, and I'll give you another update after the close today. Check the YouTube channel. If you guys like this, if you guys like these videos, send me an email, support@marketgeeks.com. Like this channel. Talk to you guys later.